From New York City for our audience worldwide, Bloomberg Real Yield starts right now. Coming up, bonds stabilizing after an epic rally, looking ahead to more inflation data in America and testimony from Fed Chair Jay Powell. We begin with the big issue, just what is behind these big bond market moves.
So there's three elements, John. There's technical, there's fundamentals, and there's policy.
What we've seen is technical short covering.
People being caught offside, people forced to cover their duration underweights.
Technicals are now bullish.
We have confirmation today that what was going on was mainly technical in nature.
I think it's both. I mean, absolutely, it's both.
We had a combination of the two, and it just was kind of warp speed up and down.
This kind of recollapse of longer-term interest rates.
There's fundamentals at work here as well as technical factors.
Growth is going to decelerate. Inflation is likely to decelerate.
We've passed peak global growth expectations. We've priced in the stimulus.
We're at the half, and it's 1-all.
The market is really torn.
We've got an interesting situation going on here.
We've got an interesting situation going on here. We've got a great panel too. Sokjen Subhadra, Eric Nelson of Wells Fargo, and Jim Bianco of Bianco Research. Subhadra, I want to begin with you, and forgive me, I've been on repeat all week. What is going on?
I think I have to agree with the guests earlier on. It was probably mostly driven by technicals. I think the positioning in the market was very short for a while, and you're seeing some of these positions getting unwound. But also on the fundamental side, there's some real concerns on the employment front. This week, we got the JOLTS report. There's 9 million job openings. There are only 7 million that are unemployed, so there's a mismatch on that front. Also, if you look at the ISM non-manufacturing, the employment component of that index came down quite sharply. And this follows a very low participation rate at the employment number that came out last Friday. And there's real concerns that the Fed might not be, on a policy front, able to achieve its goal of substantial further progress on the employment front by the end of the year, which is a precondition for them to be able to taper asset purchases.
A lot to unpack there, Subhadra. We'll come back to a bit of it in just a moment. Eric Nelson, your take first, please.
Well, John, I think one thing that's underrated is we've seen this curve flattening move happen on a global basis. So it really started with the Fed a couple weeks ago at the June FOMC with the dots, expectations of rate hikes being pulled forward. We've heard a lot from other central banks outside the U.S., including the Norges Bank, the RBNZ, and some others that are talking about raising short-term rates. And so the move down in long-end yields has been very much a global phenomenon and sort of driven by this transmission, which sort of runs counterintuitive to what you'd think. Higher short-end yields doesn't always mean higher long-end yields. In some cases, it means the opposite.
And Jim Bianco, that's what we've seen play out. Now, some people might come on this program and say, this is just a monster short squeeze. I know you don't buy that.
Yeah, there's not, first of all, as a caveat, there's really not good data on how short the market is, but the data that we do have suggests the opposite, that there wasn't a short in the market, and what it is it's a rush of people to get long. So it looks like the mirror opposite of March. March was a short. March was everybody getting short when we hit 180 on the 10-year note. When we hit 125 yesterday, that looks more like a rush to get long, that a lot of momentum players bought the market. And a lot of those momentum players are now underwater with the big backup that we've seen, at least since yesterday's yield lows. So if it is more the longs buying the market, this couldn't be more the end of the move than the beginning of a move, because usually a short squeeze is kind of what you would have in the middle of a move. So we might be closer to the end than a lot of people think in terms of the fall in yields.
Whether it is technicals or fundamentals, though, what has taken place over the last month, and I think you'd all agree, you get the price move, then the narrative. Subhadra, this has reinforced this existing narrative that we have gone through peak everything and that we can fade the inflationary fears that we saw in the break-evens in May. And to Jim's point, when we topped out at the end of March on a 10-year nominal rate pushing 180, do you think that is the current stance now? That is the dominant narrative? Not necessarily the correct one, but the consensus view that we're past a lot of this?
It might be starting to get to be a consensus view, but the fact of the matter is we just don't have enough information. We got the June data for employment last week. Next week, I think we get a ton of data that's going to suggest what the growth pattern is going to look like for the remainder of the year. So I think it's just too early to capitulate on the growth front. Perhaps growth expectations were somewhat more optimistic, and we're starting to pare back some of that optimism. But I still think that the economy is on a very strong trajectory in the second half.
Subhadra, you mentioned next week. Let's talk about next week. July 13th, we get CPI data. Now, Eric, let's play a game. If I could tell you precisely what that inflation print would be next week, could you tell me how this bond market would respond to that information directionally, with any accuracy whatsoever?
Well, John, I think predicting the data is hard enough, never mind the market reaction. But it strikes me that whereas maybe 2 or 3 months ago, risks were tilted toward, people weren't expecting inflation and they got it. Now it seems that the market is now on the other side of that, where inflation is supposedly already fully priced in, and we don't think there's any more room for upside surprises. So if you do get those upside surprises, which we think is possible, the market looks like it's poised for a sharper move to the upside in terms of those long end yields. So that's where the risks are in our view.
Well, Eric, that's what I wanted to talk about. And Jim, I'd love your view on that too, because I know some people take the opposite view of this. We had Ian Ligon of BMO join us a little bit earlier this morning on Bloomberg TV and radio, and he made the point that the reaction function now might be slightly counterintuitive, that upside surprises on inflation may lead to people thinking a little bit more about a more aggressive Fed, bringing the Fed forward. So you get this condition where there is a surprise to the upside of inflation, but actually that leads to lower yields. It's bullish bonds, 10s, 30s at the long end. Where would you come down on that debate, Jim?
It's a difficult debate to come down on, because I would agree with Ian that this is an unusual environment, and trying to gauge the reaction function is going to be a little bit difficult. But stepping back, bigger picture, yields, the 10-year yield is 50 basis points a year ago, hit 180 in March. It's 135-ish right now. It's only retraced about 1/3 of the previous rise in yields. That's still an uptrend. And I still think that we're fundamentally in an uptrend in yields. So if we get big inflation numbers, my suspicion is that that will be viewed as negatively for the bond market, and we'll still see higher yields, more of a traditional response, understanding, though, that this post-pandemic period is unlike anything we've seen, and this Fed policy is unlike anything we've seen. So any other type of reaction wouldn't shock me, but I'll go with the more traditional type of reaction.
Which side of the debate do you come down on, Subhadra?
I think I favor Jim's response in the sense that I think that 2s10s part of the curve is definitely very flat relative to fundamentals. Yes, this is a very different paradigm after the financial crisis. Curves in general are a lot flatter than they were prior to 2008. So yes. In some respects, I feel like the curve is going to be quite flat relative to past cycles, but I think that there's still a decent amount of room for the 2s10s part of the curve to steepen and for the sell-off to be led by the belly, especially at the face, especially as we enter into tapering of asset purchases. There's just a lot of long-end supply, and in some respects, as the Fed steps away from the market, you should see that get priced into higher yields in the bond market.
So when people start to agree on this show, you guys will have to forgive me, because I have to take the other side to try and make this a little bit more interesting, as you know. So this is the argument that I think some other people would put forward as a counterpoint. The change that we've seen is a Federal Reserve just shifting emphasis. That's all we had to see. Not a reaction function shift, not a forecast shift, just the balance of risks around that forecast. And that was enough to deliver a bullish reaction in bonds. So we've had this situation where they've talked more about tapering, but bonds have rallied. They've not sold off. And I think we have to pay attention to that, point one. Point two, some people would also make the argument, I think Citi out there doing some research, and my colleagues Elizabeth Stanton and Liz McCormick have looked at this. Citi pointed out that you can have a yield curve that on average peaks 12 months before the first hike. And I think you could make the very argument that this is what's going on here. If you believe that this Fed is going to be more responsive to upside surprises, this could well lead to lower yields at the long end. And you could also make the argument that if you believe 12 months away from us right now is a rate hike, then perhaps the peak in the yield curve's already in. Jim Bianco, your response to that argument?
The argument makes perfect sense. The argument is what has been the case for the last 12 years, because we've been in a low inflation or disinflationary, maybe even deflationary environment. But if the market is now reacting to something we haven't seen in a generation, and that's inflation, and you could argue that right now, at least the headline numbers and the core numbers are the highest numbers we've seen in 30 years, then you could expect a bit of a different response out of the market and that we would see higher yields as we move forward. But if inflation is indeed transitory, and count me as one of those that's not convinced it is transitory, then yes, the reaction that we've seen over the last 12 years, which you laid out, would be exactly what you would expect.
Well, I think what I'm describing right now on the bullish side of the argument, and Eric, I'd love your view on this, is actually a more mid to late cycle reaction function in the bond market. And I think some of the confusion around this story right now is no one really has any idea where we are right now in this cycle. It feels like we're at a real inflection point. We've had the restart, the reopening, but where are we at the moment? And can we really draw a parallel with this short, slow, long recovery, the trajectory of the previous cycle, the previous decade? Eric, your thoughts?
Well, John, to me, this all hinges on whether the Fed is truly committed to flexible average inflation targeting. The big problem from the June FOMC was the dots signaled some members, particularly some of the regional governors, sort of blinked on this higher inflation, this transitory inflation that we're seeing. But if you can see that the core of the Fed regain control of the narrative, get the governors more on board with this FAIT sort of framework, then I think there is potential for this cycle to run for quite a bit longer. And perhaps we are in the early or mid sort of stages of that cycle. But if you see this traditional Fed return of hiking ahead of inflation, where they don't really commit to the average inflation targeting framework, then we're probably...
I can assure you that Eric doesn't usually speak that slowly. Eric Nelson, we're going to have to re-establish that connection with him. Eric Nelson from Wells Fargo is going to stick with us alongside Jim Bianco of Bianco Research and Subhadra Japa of SocGen. Everyone's going to be sticking with us. There's a lot to discuss ahead of next week when we hear from Fed Chair Jay Powell. Next up's the auction block. Yankee issuance dominating debt sales with US banks preparing for earnings season. Also coming up next week. That conversation's next. This is Bloomberg.